Alright, dear students and scholars, in the last two videos, we built the property, plant, and equipment cost base and then allocated that cost through depreciation, depletion, and later cost analysis. Now we enter the impairment section of ASC 360. And here is the first important idea. Impairment does not begin with a calculator, it begins with a signal. Before we measure fair value, before we record a loss, and before anyone opens a valuation model, accounting must identify evidence that a long lived asset or asset group may not recover its carrying amount through use and eventual disposition. Impairment indicators matter because they decide whether a recoverability test is performed at all. If a genuine indicator is missed, assets may remain overstated on the balance sheet. But if accounting overreacts to weak or unclear evidence, the company may create unnecessary testing work and avoidable earnings volatility. The controller needs verified business facts, not assumptions wearing a nice accounting suit. Good impairment analysis starts with asset accuracy, correct expense timing, supported forecasts, and a clear audit trail through the close process. Here is the learning path for this video. We will move from business signal to evidence gathering, then to asset group definition, primary asset identification, cash flow estimates, and the undiscounted recoverability screen. If the screen fails, that leads to fair value measurement, but that is for video 4. In this lesson, our job is to decide whether the asset group should move into measurement. The memory hook is simple: signal, evidence, group, primary asset, cash flows, screen, then measure only if needed. ASC 360 has two different impairment and exit paths. The first path is for long lived assets that are held and used. These assets remain in operations, so accounting assesses indicators, defines the asset group, and performs the undiscounted recoverability screen. The second path is for assets classified as held for sale, where the model changes to fair value less cost to sell and depreciation stops. This video focuses entirely on the held and used path. Held for sale classification is coming later, so do not mix the two models. A held and used asset is still operating. It may be underperforming, outdated, damaged, or facing weak demand, but it has not yet met the criteria for sale classification or abandonment. The key question is not whether management is happy with the asset. Many managers are not happy with many assets, and thankfully, that alone is not an accounting standard. The real question is whether the carrying amount can be recovered through remaining use and final disposition. That is why indicator review comes before measurement. ASC 360 uses trigger based testing for property, plant, and equipment. Unlike Goodwill under ASC 350, PPE does not require an automatic annual impairment test for every asset. Instead, accounting assesses whether events or circumstances indicate that carrying amount may not be recoverable. If no indicator is present, a recoverability test is generally not performed, but that conclusion still needs to be actively assessed and documented. No formal test does not mean no review. It means the review did not identify a trigger. A significant decrease in market price can be an impairment indicator. This is not about ordinary market noise or small fluctuations. The decline must be meaningful enough to raise concern about recoverability. Accounting should corroborate the signal with evidence such as broker quotes, independent appraisals, auction data, or comparable arm's length sales. The stronger the evidence, the stronger the indicator conclusion. A casual comment that prices seem down is not enough for a close memo. Changes in use or physical condition can also trigger impairment analysis. If a production line is shut down, used at a fraction of design capacity, shifted to a lower value use, or physically damaged, the asset may no longer support the original cash flow expectations. This can also include accelerated wear, technological obsolescence, or regulatory modifications that reduce productive life. The important discipline is documentation. The memo should explain what changed, when it changed, how significant it is, and how it affects expected cash flows. Legal, regulatory, and business changes can reduce recoverability even when the asset itself is physically fine. A plant may still run smoothly, but new environmental rules, permit issues, trade restrictions, product bans, technology shifts, or falling market demand can reduce the cash flows that the asset group can generate. The asset may be healthy, but the economics around it may have become unhealthy. ASC 360 cares about recoverability, not just whether the machine still turns on. Cost overruns can be more than a budgeting problem. If acquisition or construction costs significantly exceed the original plan, accounting must ask whether the completed or in progress asset can recover the higher capitalized cost. The recoverability question uses actual invested cost, not the old approved budget that everyone wishes had stayed true. Evidence should include the revised business plan, updated revenue and cost projections, the reason for the overrun, and management's expectation of future operating performance. Current losses need context. A single period of operating loss or cash flow loss is not automatically an impairment indicator. It becomes more serious when paired with a history of losses or an approved forecast showing continuing losses. Accounting should connect actual results to forward looking management plans. If management has supportable evidence showing near term recovery, that may affect the conclusion. But if the forecast shows continuing negative cash flows, the recoverability test may be required. An early disposal expectation can also trigger impairment review. If management expects to sell, abandon, or otherwise dispose of a long lived asset significantly before the end of its previously estimated useful life, the cash flow period available to recover the carrying amount becomes shorter. That may require both a recoverability test and a useful life reassessment. For example, if an asset originally had a 20-year life, but management now plans disposal at year 12, depreciation and cash flow projections need to reflect that new reality. Indicator assessment is a cross functional close process workflow. Accounting should not sit alone and guess what is happening in the plant. The team gathers facts from plant managers, business unit leaders, FP&A, legal, tax, strategy, and valuation specialists when needed. The close memo should identify the business signal, summarize the evidence requests, define the asset group, tie forecast assumptions to approved management plans, and document the controller's conclusion on whether a recoverability test is required. An asset group is the lowest level of assets and associated liabilities for which identifiable cash flows are largely independent from other groups. This definition is extremely important. If the group is too broad, impairment in a weak unit can be hidden by strong cash flows elsewhere. If the group is too narrow, accounting may create artificial impairment even though the assets work together economically. The asset group should reflect operational reality, not merely the fixed asset register or a convenient management report. The correct cash flow level depends on facts and circumstances. Sometimes the asset group is a product line or production cell. Sometimes it is a plant, facility, division, reporting unit, segment, or even the whole entity. The test is whether cash inflows are identifiable and largely independent. A fixed asset register might list every machine separately, but that does not mean each machine has independent cash flows. ASC 360 asks how the asset group actually generates cash, not how nicely the subledger is organized. The primary asset matters because it usually sets the period over which cash flows are projected for the recoverability screen. The primary asset is the long lived tangible or finite lived intangible asset that provides the most significant cash flow generating capacity in the group. Supporting equipment, tooling, leasehold improvements, working capital items, and related liabilities may be in the group, but the primary asset drives the projection horizon. Land cannot be the primary asset because it has an indefinite life. Some assets do not generate standalone cash flows. A corporate headquarters building, enterprise wide IT system, or shared service center may support many business units without having independent revenue or cash inflows. In that situation, recoverability may need to be assessed at the broader level whose cash flows the shared asset supports. The memo should explain why a lower level asset group was not achievable and why the broader testing level reflects the economics. Goodwill must be kept separate from ASC 360 impairment testing. Goodwill is tested under ASC 350 at the reporting unit level using its own impairment model. ASC 360 applies to long lived assets such as PPE and finite lived intangibles. The two standards may interact when the asset group corresponds to a reporting unit, but the model should not be blended. Do not include goodwill in the ASC 360 carrying amount for the long lived asset group test. Mixing impairment models is like mixing two recipes and then wondering why the cake tastes like a spreadsheet. Before applying the ASC 360 recoverability screen, accounting should clean the group under other applicable guidance. Receivables should be evaluated under the relevant receivable and credit loss guidance, including ASC 326 where applicable. Inventory should be reviewed under ASC 330. Investments should be assessed under their own guidance, such as ASC 321 or ASC 323 where relevant. Liabilities should also be recognized or adjusted under applicable standards. Only after those adjustments should the ASC 360 screen be applied to the long lived asset group. The recoverability screen compares the carrying amount of the asset group with the sum of undiscounted expected future cash flows from use and eventual disposition. This is not a fair value test. If undiscounted cash flows are greater than or equal to carrying amount, the asset group is recoverable and no ASC 360 impairment loss is recognized, even if fair value is lower. If undiscounted cash flows are less than carrying amount, the screen fails and the asset group moves to fair value measurement in video 4. Cash flow estimates must be disciplined. Include operating cash inflows and outflows from continued use, expected net proceeds from eventual disposition, maintenance capital needed to preserve current service potential, and probability weighted scenarios based on available evidence. Exclude interest expense recognized as incurred, future expansion capital expenditures that increase service potential, cash flows from assets outside the defined group, and unsupported optimistic projections. In short, use supportable use and disposition cash flows, not wishful thinking with a discount free glow. Now, let us apply the screening workflow to the 2026 packaging line case. The line loses its largest customer in Q2, reducing projected revenue by 40%. That is a significant adverse business change and creates a possible loss pattern signal. The asset group is the packaging line because it has largely independent cash flows and includes the primary packaging machine, support equipment, and related leasehold improvements. The carrying amount is $6.2 million. Supported undiscounted cash flows from use and sale are $5.7 million. Because 5.7 million is less than 6.2 million, the asset group is not recoverable and proceeds to fair value measurement in video 4. That completes video 3. Remember the sequence. Identify indicators, gather cross functional evidence, define the asset group, identify the primary asset, estimate undiscounted cash flows from use and disposition, and compare those cash flows with carrying amount. If the screen passes, no impairment loss is recorded. If the screen fails, fair value measurement comes next. In video 4, we will calculate the impairment loss and record the journal entry. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP with practical examples.